All right, folks, buckle up. This is a big one. In the most recent Berkshire Hathaway annual meeting, Warren Buffett dropped a bombshell. He revealed that they almost pulled the trigger on a $10 billion investment. Yeah, you heard that right, $10 billion. And this wasn't just any stock, it was a move that speaks volumes about how Buffett is thinking in this current market. Now in just a moment, I'm going to roll the clip from CNBC where Buffett shares that insight directly. But after that, I'll give you my personal reaction, what stood out to me, what I think it means, and how it fits into the bigger picture of Berkshire's strategy. I'm going to break it all down for you. We're going to unpack what Warren really meant when he talked about holding over $300 billion in cash, why Berkshire Hathaway isn't in a hurry to spend it, and what that says about market conditions, risk, and long-term strategy. This isn't just an old man hoarding money, this is chess, not checkers. And stick around because after we break down Buffett's comments, I'm going to dive into one undervalued fintech giant that Berkshire has recently bought into. Trust me, it's one you don't want to overlook. If you're only going to watch one video today, make sure it's this one and watch it all the way to the end. Smash that like button. Let's get this video to 1,000 likes. Share it with someone who needs to hear this. Drop your thoughts in the comments below. And of course, subscribe to the channel so you never miss the next big financial insight. All right, let's jump into it. Here's what Warren Buffett had to say.
This next question comes from 𝗣𝗟𝗏𝗧 in New York. He writes, today Berkshire holds over $300 billion in cash and short-term investments, representing about 27% of total assets, a historically high figure compared to the 13% average over the last 25 years. This has also led Berkshire to effectively own nearly 5% of the entire U.S. Treasury market. Beyond the need for liquidity to meet insurance obligations, is the decision to raise cash primarily a de-risking strategy in response to high market valuations, or is it also a deliberate effort to position Berkshire's balance sheet for a smoother leadership transition, providing Greg Abel with maximum flexibility and a clean slate for future capital allocation decisions? And I will add one line from another shareholder, Mike Conway, who asks, are you encouraged you may see some fat pitches coming your way?
Yeah. Well, I wouldn't do anything nearly so noble as to withhold investing myself just so that Greg could look good later on. Now, if he gets any edge when I leave, I'll resent it. So the amount of cash we have is we would spend, we came pretty close to spending $10 billion not that long ago, for example. But we'd spend $100 billion. I mean, and those decisions are not tough to make. When something is offered that makes sense to us and that we understand and offers good value and where we don't worry about losing. And the one problem with the investment business is that things don't come along in an orderly fashion, and they never will. I mean, it isn't like every day. The long-term record is sensational, but that is not a product. And I've been in, I've had 200 trading days times 80 years. It's 16 million trading days. We kind of, 16,000 trading days. It would be nice if every day you got 4 opportunities or something like that, and you could, and they were expected to be equally attractive. If I was running a numbers racket, every day would have the same expectancy of that I would keep 40% of whatever the handle was. And so the only question would be is how much we transacted. But we're not running that kind of a business. And so we're running a business which is very, very, very opportunistic. And Charlie always thought I did too many things. He thought if we did about 5 things in our lifetime, we'd end up doing better than if we did 50, and that we never concentrated enough, so that we would rather have if we've got $335 billion now in treasuries, we would rather have conditions that are developed where we would have like 50 billion or something like that. But that just isn't the way the business works. And we have made a lot of money by not wanting to be fully invested at all times. And we don't think it's improper, actually, for people who are passive investors just to make a few simple investments and sit for their life in them. But we've made the decision to be in the business, so we think we can do a little better than that by behaving in a very irregular manner. But if you told me that I had to invest, let's say that we have a roughly 40 billion a year coming in, and we start with 335. If you told me I had to invest 50 billion every year till we got down to 50 billion, that would be the dumbest thing in the world to invest in that manner. Things get extraordinarily attractive very occasionally. The long-term trend is up. Nobody knows. And I certainly don't know. Greg doesn't know. Ajit doesn't know. Nobody knows what the market is going to do tomorrow, next week, next month. And nobody knows what business is going to do tomorrow, next week, or next month. But they spend all their time talking about it because it's easy to talk about. And but it has no value. I've never found anybody I wanted to listen to on the subject. And on the other hand, I've found that leafing through things like that big Japanese book that I can't read anymore, that's a treasure hunt. And every now and then you find something, and occasionally, very occasionally, but it'll happen again, that I don't know when. It could be next week, it could be 5 years off, but it won't be 50 years off. We will be bombarded with offerings that we'll be glad we have the cash for. And it'd be a lot more fun if it would happen tomorrow, but it's very unlikely to happen tomorrow. Very, very unlikely to happen tomorrow. But it's not unlikely to happen in 5 years. And then the probabilities get higher as you go along. It's kind of like death. I mean, if you're 10 years old, the chances that you're going to die the next day are low. If you get to be 115 or something like that, it's almost a cinch. Particularly if you're a male. I mean, all the records are held by females in terms of age. And I tried to get Charlie to have a sex change so he could test out whether... he did pretty well for being a male, I'll put it that way. Okay.
So let's start with the first big question. Why is Berkshire Hathaway sitting on this mountain of cash, over $300 billion in cash and short-term investments, nearly 27% of the company's total assets? Buffett's response here is classic Warren. He doesn't dress it up in corporate PR. He doesn't spin it. He essentially says, look, we're not sitting on this cash to help Greg Abel look good after I'm gone. And the audience laughs, because of course Buffett doesn't do symbolic gestures. He's a value guy. He's not sentimental about legacy in that way. But here's what's interesting. That mountain of cash? It's not some strategic pause because they're confused. It's discipline. It's patience. Buffett is waiting for what he calls fat pitches. Those rare, high-conviction investment opportunities where the odds are dramatically in his favor. Buffett explains something really important about how investing actually works, especially at his scale. He says, the investment business doesn't hand you opportunities in a neat, orderly fashion. This isn't a predictable job like running a numbers racket where the returns are mechanically consistent. Instead, he compares Berkshire's investing style to a very, very opportunistic business. He even jokes about how Charlie Munger used to say he did too many things, and that doing fewer, but better, investments would actually outperform the scattergun approach. So what's the lesson here? The real pros, the ones like Buffett, they wait. They don't try to dollar-cost average into every opportunity. They don't chase trends. They don't care what CNBC says the market is going to do this week. They sit patiently, quietly, sometimes for years, and then go all in when the odds are undeniably in their favor. Buffett makes a key point. He would spend $100 billion if the right opportunity came along. And not just any opportunity. It has to be something they understand, where the value is clear and the risk is low. He mentions they almost spent $10 billion recently. But almost isn't enough. If something doesn't meet their criteria, they don't pull the trigger. Here's the golden quote from Buffett that really hits home. "We have made a lot of money by not wanting to be fully invested at all times." That's powerful, because it goes against everything the average investor is taught. Everyone tells you not to try to time the market, but Buffett's not timing the market. He's timing opportunities. And there's a huge difference. Another gem in this interview is when Buffett dives into the unpredictability of markets. He's brutally honest. Nobody knows what the market is going to do tomorrow, next week, next month. Not me, not Greg, not Ajit, nobody. And he says people talk about it constantly because it's easy to talk about, but it has no value. That line right there, that's Buffett telling you to tune out the noise. Forget the headlines, forget the forecasts. If it doesn't help you make a better decision, it's just clutter. What Buffett does care about is being ready when the odds turn in his favor. And that's where holding cash becomes a strategic weapon. He says, eventually, we'll be bombarded with opportunities, and we'll be glad we have the cash for it. It might not happen tomorrow, it might take 5 years, but it will happen. And when it does, Berkshire will be one of the only players with enough dry powder to act decisively. I love the analogy Buffett uses when talking about timing. He compares opportunity to mortality. If you're 10 years old, the odds of dying tomorrow are low, but if you're 115, the odds are basically guaranteed. Same with investing. The longer you wait, the higher the probability that something undeniably good will come your way. And when it does, you better have the capital and the conviction to seize it. This mindset explains everything Buffett is doing right now. It explains the $300 billion in cash. It explains why he's not rushing. And it explains why Berkshire, even after all these years, is still a fortress, built to survive the dry spells and dominate when the tides turn. So, if you're wondering what to take away from this interview, here's my take. Don't be in a hurry to invest just because you feel like you should be doing something. Be patient, sit on your hands, wait for your fat pitch. And when you find something you understand, something you believe in, swing hard. Warren Buffett's not just hoarding cash for the sake of it. He's playing the long game, and doing it with humility, discipline, and precision. That's a masterclass in investing, and it's why, even at 93, he's still schooling the market. If you enjoyed this breakdown, make sure to like, subscribe, and let me know in the comments what you found most interesting from Buffett's talk. Now let's dive into the one undervalued fintech giant stock that Berkshire has recently bought into. Nu Holdings, listed on the New York Stock Exchange under the ticker symbol NU, is a leading digital banking platform transforming the financial landscape in Latin America. Founded in Brazil, Nu offers a wide range of financial services including credit cards, personal loans, and investment products, all accessible through its user-friendly mobile app. Both Buffett and Wood recognize the immense potential of Nu Holdings, albeit for different reasons. Let's explore their perspectives in detail. From a value investing standpoint, Nu Holdings ticks all the right boxes for Warren Buffett. Known for his meticulous approach to investing, Buffett has always emphasized the importance of understanding the intrinsic value of a company. He looks for businesses that not only have strong fundamentals but also possess a durable competitive advantage. Nu Holdings, with its innovative approach to banking and financial services, fits this mold perfectly. The company boasts a dominant market position in Brazil, with over 70 million customers and a reputation for exceptional customer service. This is no small feat in a country with a rapidly growing economy and a diverse population. Nu Holdings has managed to capture a significant share of the market by offering user-friendly digital banking solutions that cater to the needs of modern consumers. Their mobile-first approach has resonated well with tech-savvy Brazilians, making banking more accessible and convenient than ever before. This translates into a wide economic moat, a key characteristic that Buffett looks for in his investments. An economic moat refers to a company's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share. Nu Holdings' strong brand recognition, customer loyalty, and innovative technology create significant barriers to entry for potential competitors. This ensures that the company can sustain its profitability and continue to grow in the long run. Moreover, Nu Holdings operates in a highly profitable and underbanked market, providing ample room for expansion. Brazil's financial sector has historically been dominated by a few large banks, leaving many consumers underserved. Nu Holdings has capitalized on this opportunity by offering affordable and accessible financial products to a broader audience. Their innovative solutions have not only attracted millions of customers, but have also set the stage for future growth as they continue to expand their services and reach new markets. The company's strong financials, including consistent profitability and a healthy return on equity, further solidify its appeal to a value investor like Buffett. Financial stability is crucial for any investment, and New Holdings has demonstrated its ability to generate steady profits while maintaining a robust balance sheet. Their impressive financial performance is a testament to their effective management and strategic vision. For value investors, this combination of strong fundamentals, growth potential, and a solid economic moat makes New Holdings an attractive investment opportunity. Cathie Wood, with her focus on disruptive innovation, also sees New Holdings as a trailblazer in the fintech revolution. The company's technology-driven approach to banking, coupled with its commitment to financial inclusion, aligns perfectly with Wood's investment thesis. New Holdings' rapid growth trajectory, fueled by its innovative products and services, is another factor that resonates with Wood's growth-oriented investment strategy. The company's expansion beyond Brazil into other Latin American markets further strengthens its long-term growth prospects. Latin America presents a compelling investment opportunity for both value and growth investors. The region's economic landscape is evolving rapidly, driven by a combination of demographic trends, technological advancements, and increasing political stability. Investors are particularly drawn to the potential for high returns, given the region's untapped markets and the growing demand for modern financial services. The region is home to a large and young population, which is a significant advantage. This demographic dividend means a growing workforce and a burgeoning consumer base, both of which are essential for sustained economic growth. Young people are more likely to adopt new technologies and services, making them a key target for innovative companies like New Holdings. With a growing middle class and increasing smartphone penetration, the digital landscape in Latin America is ripe for disruption. The middle class is expanding as more people move out of poverty and into better-paying jobs. This shift is accompanied by a rise in disposable income, which fuels demand for a variety of goods and services, including financial products. Smartphone penetration is also on the rise, providing a platform for digital banking solutions to reach a wider audience. However, traditional banking infrastructure remains underdeveloped in many parts of Latin America, particularly in rural and underserved urban areas. Many people still lack access to basic financial services, such as savings accounts, loans, and credit cards. This gap in the market presents a unique opportunity for fintech companies to step in and offer innovative solutions that can bridge the divide, creating a significant gap that New Holdings is perfectly positioned to fill. By leveraging technology, New Holdings can provide accessible and affordable financial services to millions of people who have been excluded from the traditional banking system. Their user-friendly app and customer-centric approach make it easier for people to manage their finances, save money, and access credit. New Holdings' focus on providing accessible and affordable financial services to the underbanked population in Latin America aligns with the broader trend of financial inclusion. Financial inclusion is not just about providing access to banking services, it's about empowering people to improve their financial well-being. By offering products like low-cost loans, savings accounts with no minimum balance, and easy-to-use mobile banking, New Holdings is helping to lift people out of poverty and into the financial mainstream, making it a socially responsible investment as well. Investing in companies that prioritize financial inclusion and social impact can generate both financial returns and positive societal outcomes. New Holdings is committed to community development and sustainability, supporting projects that improve education, healthcare, and economic opportunities in the regions they serve. This dual focus on profit and purpose makes New Holdings an attractive option for investors who want to make a difference while also achieving their financial goals. While Brazil remains New Holdings' core market, the company has embarked on an ambitious expansion strategy, targeting other high-growth markets in Latin America. New has already launched its operations in Mexico and Colombia, two of the region's largest economies, with plans to expand further in the coming years. This expansion strategy is crucial for New Holdings to maintain its impressive growth trajectory and achieve its goal of becoming the leading digital banking platform in Latin America. New Holdings' financial performance has been nothing short of stellar. The company has consistently grown its revenue and customer base at an impressive pace, while also demonstrating a clear path to profitability. With a market cap of $60.4 billion, and earnings per share of 0.41 and a price-to-earnings ratio of 30.26, the company is gaining attention for more than just its numbers. It's the story behind the numbers that really stands out. In 2024, New reported $11.52 billion in revenue, reflecting a massive 43% growth year over year. Even more impressive, net income hit $1.97 billion, nearly double what they posted the year before. That kind of performance translates to a return on equity of 32%, which is a strong indicator of profitability and efficient management. But it's not just the financials turning heads. News customer base has skyrocketed past 114 million users, with major traction in Brazil, Mexico, and Colombia. That kind of scale shows they're not just growing, they're dominating. One of the most important milestones this year was regulatory. New Mexico secured a banking license. That's a game changer. It paves the way for Nu to operate as a full-service bank, expanding its offerings and deepening its presence in the Mexican market. It also marks a major push toward greater financial inclusion and healthy competition in a region long dominated by traditional banks. Naturally, this kind of progress is starting to catch the eye of the investment community. Analysts and market watchers are highlighting Nu Holdings as an undervalued gem in the fintech sector. With such strong fundamentals and strategic moves in place, many believe the company is well on its way to becoming a dominant force in Latin America's financial ecosystem. Stock price momentum is already reflecting investor confidence. With its consistent financial performance, strategic regulatory wins, and a rapidly expanding user base, Nu Holdings is positioning itself as a long-term growth story. Analysts are signaling strong potential for future gains, and for anyone watching the fintech space closely, Nu is definitely one to keep an eye on. Its strong financials are a testament to the effectiveness of its business model and the strength of its management team. Nu Holdings' ability to attract and retain customers, coupled with its efficient operations, positions it for sustained financial success in the years to come. The convergence of favorable market dynamics, a robust business model, and a strong track record of execution makes Nu Holdings a compelling long-term investment opportunity. The company is well positioned to capitalize on the growing demand for digital financial services in Latin America and beyond. What are your thoughts on Nu Holdings' growth potential? Share your insights in the comments below. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. No hype, just proven, timeless investing principles that work. Click the link in the description to get the course today at a 67% discount and take control of your financial future today. Join the fintech revolution. Don't miss out on the opportunity to invest in the future of finance and technology. Join Stocks Galore's exclusive Patreon community for access to premium stock tips, in-depth analysis, and much more. Like this video and subscribe to our channel for more insightful content on the world of finance. Until next time, happy investing.